Yeah, when we consider investing into emerging markets, or in fact to any part of the infrastructure investment universe, there are a couple of things that we want to consider first. And the first of those is, what's our investment objective? Our investment objective in investing into infrastructure is about achieving, firstly, steady returns, steady, reliable returns, and secondly, about achieving inflation protection. When we come to define infrastructure as an asset class, we define infrastructure as being assets that provide essential services, things that you really can't do without: water, power, transport for that matter. So essential services, and therefore very reliable revenues. And then secondly, about not being exposed to external variables that might influence those revenues. So things like commodity prices. The oil price goes up and down. We don't want to be influenced by that. We don't want to be influenced by competition. We want effectively a monopolistic style of revenue. We don't want to be influenced by technology. And finally, we don't want to be influenced by sovereign risk. And it's sovereign risk that we need to be most concerned about when we go into emerging markets. Emerging markets, by their nature, tend to have developing legal and political systems, and therefore there's a level of risk there. So as much as these assets might be highly attractive, from our perspective, we think we need to be very cautious about whether or not they'll deliver us the reliability that we seek in infrastructure investment, in addition to that inflation protection. So when we come to define infrastructure, we think about those two things: that the reliability of the revenue stream, due to the fact that it's an essential service, and the fact that that revenue then doesn't get affected by those external variables. So the universe that we're left with is really two parts. It's firstly, it's utilities, and utilities account for about 3/4 of our investment universe. So utilities are energy transmission and distribution, the poles and wires that bring the energy into your home, and for that matter, the pipes that bring gas into your home. Similarly, the pipes that bring water and take wastewater away from your home. These things are essential. You can't live without them. But in addition to that, you don't want two sets of these things coming into your house. They're a natural monopoly. So those utilities, they're about 3/4 of our universe. The other quarter of our universe is infrastructure. It's things like toll roads, ports and airports. Once again, these are services that are essential and effectively are monopolies. Toll roads typically face very little competition within their catchment. So they've got a very reliable underlying demand base, a very reliable set of revenues, particularly over the long term. In addition to which, as most of us will know from driving on toll roads or going through airports, there's a level of inflation protection. The price rises and falls with inflation, so you get that inflation protection in addition to that solid demand base. So in both cases, in both the case of utilities, in the case of infrastructure assets, very stable returns, inflation protection, and that's really what we find ourselves investing in. When we consider global infrastructure versus Australian infrastructure, we're looking for a couple of things, or we're considering a couple of different factors. First of all, when we think about the rest of the world, by its nature, Australia is a small part of the world, so there's a lot more opportunity out there. And not surprisingly, we would consider that some of the best assets in the world are actually not in Australia. If I think about toll roads, arguably the best toll road in the world is the 407 toll road in Toronto, Canada. The 407 faces a competing road which has full pretty much all day long in terms of its capacity, so it has no spare capacity. It has the ability to grow tolls at a rate that it sees fit. It's not bound by any artificial constraint. And as a result, it's been able to grow its earnings, double-digit compound, sort of 15% compound over the last 10 years. Very strong growth rates of earnings with high reliability. So that's in the toll road space. In the utility space, the energy transmission in the US earns very attractive regulated returns relative to the rest of the world, certainly very attractive relative to Australia. And there's a range of transmission assets in the United States where offer these very attractive returns to investors. Similarly, in the port space, in Australia, we're unable to invest in a pure port play. There are those opportunities in the rest of the world. And similarly in airports. In airports, there's a range of extremely attractive airports, Zurich Airport, Frankfurt Airport and Auckland Airport, all extremely attractive opportunities which you won't get in the Australian space. So that's the first thing. It's a large world, there are some attractive opportunities out there. The other things to think about are the way that Australian infrastructure has been characterised relative to global infrastructure. So Australian infrastructure as a grouping has a much higher debt levels than the rest of the world. Now infrastructure can withstand a fair amount of debt, it's very reliable cash flows, it can handle some debt. But Australians have made an art form of taking debt to really high levels. So typically what we find is that an Australian infrastructure asset versus its international comparative has about 10% more debt in its capital structure. Again, fine when things are going well, but if things are not going so well, that can be a problem. So higher debt levels than the rest of the world. Australian assets, infrastructure sector assets are characterised by a high degree of external management. That is, they're managed by some third party. If you think in the past there have been a number of infrastructure assets managed by Macquarie Bank, by Babcock and Brown and other entities. That's a model that really doesn't exist anywhere else in the world. That's a peculiarly Australian characteristic. Again, there's nothing intrinsically wrong with that, but what you do find is that you have assets that managed by people whose underlying interests are not always best served by acting in behalf of in the same way as shareholders. So it's something to be aware of. And the third thing to think about it with Australian assets is the level of history. You know, Australian infrastructure sector is relatively young, 10 to 20 years old. Some of the things we've been able to invest in the Magellan Infrastructure Fund have histories of 130 to 150 years. Enstar is a energy utility in northeast of the United States, has been around for near on 150 years, paid dividends in every year. Similarly, Consolidated Edison operates in the Isle of Manhattan in New York, has been operating for 130 years and has increased dividends every year for the last 35 years. That sort of depth of history gives you a sense of reliability, you know what you're looking at, you know what you're investing in. So for all of those reasons, we think global infrastructure offers a range of characteristics that make it relatively attractive compared to Australian infrastructure.